In this lecture, we will cover the CFA Level 2 reading on private equity valuation. So these are the sections that we'll cover: an introduction followed by valuation techniques. Then we'll talk about private equity fund structures and valuation. Then concept in action, where we'll take the concepts that we study in section 3 and apply them to a simple case. And then section 5 plus an appendix refers to an application of what we are talking about, and specifically it is a case study that has been written by a Stanford professor about valuing investments. This will be a separate lecture, and this is also important. Let's start with an introduction. First, the definition of private equity. Private equity refers to the entire class of equity investments not quoted on stock markets. So not quoted on stock markets is what makes it private, and the fact that these are equity investments is where the equity is coming from. We will look at two perspectives. One perspective is that of an outside investor evaluating a fund sponsored by a private equity firm, and the other perspective is a private equity firm evaluating investments. These investments are called portfolio companies. Now, let me graphically depict this. This is a private equity firm. The private equity firm makes investments in companies. So you might have a particular fund, and that fund will consist of investments in several companies. So these are called the portfolio companies, and each of these companies will have a management team. That management team is referred to as the portfolio company management team. For short, we might just call them management. The private equity company and the funds that it runs are generally managed by people called GPs. GP stands for general partner. Then you have outside investors, so that's people over here who invest in a particular fund that is launched by the private equity firm. So these people on the outside are being called the outside investors, and in the reading we will also refer to these investors as LPs or limited partners. Now, from this picture, the two perspectives should become obvious. Perspective one is the perspective of this investor over here, or these investors who are putting their money in the fund that has been launched by the private equity firm. So this group will be looking at the performance of the fund. They will look at the performance of funds that have been launched by these GPs in the past, and so on. Perspective two is that of the private equity firm. So the private equity firm needs to evaluate companies over here and decide which companies to include in their portfolio. So clearly these two perspectives are quite different, and in this reading we cover both perspectives. There are two broad types of private equity firms: venture capital firms and buyout firms. So venture capital firms invest in small companies, startups, and then help them grow. Buyout firms invest in larger, more established companies, typically companies that are not performing too well, and then the private equity firm helps improve the buyout firm or helps improve the firms and then sells those firms at a much higher price. I would encourage you to go over Exhibit 1 in the curriculum, which gives a classification of private equity in terms of stage and type of financing of portfolio companies. I'm not emphasizing this here because this point is not mentioned in the learning objectives, but as general knowledge, it is important to understand that with VC firms, obviously the portfolio firm can be at one of many stages. There might be some VC firms that invest in very small startups that are extremely early in their life cycle. There might be other VC firms that invest in small companies where the product has been developed and maybe the marketing has just begun. So there will be various stages at which a VC firm can invest, and there is a subcategorization based on the stage at which the investment happens. Similarly, with buyout firms, there can be further subcategories, and those are all explained in Exhibit 1. This is a common point across private equity firms, the buy to sell orientation. Buy to sell orientation means that in private equity, the private equity firm makes an investment with a clear exit strategy. In other words, typically after a few years, the investment is then sold. The point being that a private equity tries to get in at a low price, and then after a few years, once the value of the investment has gone up, then that investment is sold. The selling of that investment is called an exit because it's an exit from the investment. We now come to Section 2, Introduction to Valuation Techniques. What I'll talk about here is a summary of what you will see in Exhibit 2 in the curriculum, which gives an overview of selected valuation methodologies. Now here I'm connecting back with what I said earlier. A private equity firm will set up a fund, and that fund will consist of investments. So how does a private equity firm evaluate these various investments? At a high level, these firms are evaluated based on the sorts of techniques that we have studied earlier. There was a reading on private company valuation. That is obviously going to be critical. In this particular reading, we don't go into the details of the valuation techniques. We just mention the techniques. There have been enough readings where we have talked about the income approach. So obviously this private equity firm, when it is evaluating a possible investment, it will look at the income or the cash flow or the earnings that will come from a particular company. It will have to figure out an appropriate discount rate to apply, and essentially these investments will be valued and evaluated based on the discounted cash flow approach. That is one strategy. If the discounted cash flow approach is hard to use because maybe the estimates are not easily available, let's say that you are evaluating a company which is in a relatively new industry, then you might use other approaches. This approach, the relative value approach, obviously depends on the availability of comparables. You can use a multiple of earnings. For smaller companies, you might want to use a multiple of price or ratios such as enterprise value to EBITDA. Then these last two items, we don't have much details in the curriculum either, but you have seen these concepts earlier. Some companies can be thought of as options. So we talked about this in corporate finance in the reading on capital budgeting. So sometimes you can treat projects like real options, and then the valuation is based on options theory. You can also evaluate based on replacement cost. So if you have a small company that started 2 years ago, one way of valuing the company is to say that how much will it cost for me to create another company and bring it to the level of this target company. Now, I don't think you are going to be tested here on the details of these approaches because there are several other readings where you will be tested on this. But just recognize that the sorts of techniques that you have learned are applied by private equity firms to evaluate these various investments. This reading has 6 subsections which are shown right here. We'll talk about how value is created in private equity. This is important and testable. Then very briefly, the concept of using market data in a valuation process. Section 2.3 contrasts valuation in venture capital and buyout settings. So here we'll also understand the major differences between these two. And then section 2.4 talks about valuation issues specifically in buyout transactions. 2.5 talks about valuation issues in venture capital transactions. And then finally, this section talks about exit routes. Exit again means how do you exit an investment? In this case, how does a private equity firm exit an investment? How is value created in private equity? There are several ways in which value is created. The first is to re-engineer firm and generate superior returns. This applies more in a buyout setting. The classic scenario is this. Let's say that you have a private equity firm that specializes in a given industry. So this private equity firm makes investments in established companies in that industry where these companies are struggling. Let's say that the corporate governance might be weak. Let's say that the management is not running the company efficiently and so on. So the private equity firm takes over, makes the firm more efficient, and obviously the taking over will happen at a relatively low price because this company is not very efficient. Then the private equity firm actively helps manage the company and improves the performance, makes it more efficient. What then will happen to the value of the firm? The value of the firm will go up, and then the private equity sells it off at a higher price. Another point is this. The private equity firm can access credit at relatively favorable terms. Now, there are two major points over here. Let's continue with this scenario where we have a company that's not performing too well. The cost of credit for this company is going to be very high. It's not going to be easy for a poorly performing company to raise money, and if they do raise money, the cost of raising capital will be very high. On the other hand, if you have a well-established private equity firm which has a track record of taking companies, turning them around, and in general performing well, this particular company can get debt or can borrow money at a relatively lower cost. So they borrow at a relatively low cost, use the borrowed money, and use some of their own money to buy these portfolio companies or target companies. So the ability to get funding at a relatively low cost also allows private equity companies to create value. And then this third point is extremely important. Private equity firms are structured in such a way that they align the economic interests of the private equity owners and managers of the portfolio companies. As I alluded to earlier, the managers running these particular firms in which the private equity firm is investing, so these are the managers of the portfolio companies. If the incentives of these managers are perfectly aligned with the incentives of the private equity investors, then only good things can happen. We have talked about the fact that in regular corporations, there is a major agency problem, and we have to go through a lot in order to try and minimize and mitigate those agency problems. But in private equity, it is easier to avoid those agency problems by aligning the interests of the private equity investors and the management. One scenario or one example of how these interests are aligned is a long-term perspective. And to understand this, contrast private equity with public equity. In public equity, there is generally a very strong short-term focus because investors are looking at the next earnings release, because investors are concerned about what's happening to the stock in the short run. Because of that, management might do things that are good in the short run, but not good for the company in the long run. It is very hard to overcome that challenge. But with private equity, since these portfolio companies by definition are not public, and by definition, generally the perspective is a 3, 4, 5, 6 year perspective, decisions can be made which are in the best long-term interest of all the stakeholders. What private equity firms do well in general is to establish terms or investment terms, these are called term sheets, in order to explicitly align the interest of the investors and the managers running the firm. And I'll give you a few examples. one clause that is put in, and you can think of this as the corporate governance charter in the context of private equity firms. So there is something called a tag along, drag along right. This means that, let's say that a private equity firm has invested in these portfolio companies. If there is another company that wants to acquire a target company, then this says that the acquirer must make an offer to all the stakeholders. So you can't have a situation where the acquirer only pays the private equity firm and gets the investment and the manager loses. So that way the incentives will not be aligned. But if the private equity firm and the management agree that if any new acquirer comes, then the offer will benefit both the management and the private equity investor, in other words, all stakeholders, then automatically their incentives are aligned, because if a good offer comes, both benefit. Corporate board seats. The private equity firm will in general ensure that one of their people sit on the board of each of these companies, or at least one. That way major decisions have to be approved by the private equity firm. Non-compete clause. Very often there are clauses which say that the managers over here, if they leave, they cannot engage in any competing business. This next point, preferred dividend and liquidation preference. Private equity firms generally come first when distributions take place. Distributions being if a fund is sold or if cash is generated and is returned, then generally the way things are set up is that the private equity firm gets money first. Reserved matters. What this says is that there are some areas of strategic importance which are subject to approval or veto by the private equity firm. And finally, earnouts. This refers to a mechanism linking the acquisition price paid by the private equity firm to the company's future financial performance over a predetermined horizon. In other words, the private equity is paying a certain price, and that price is contingent upon the firm performing at least at a certain level over a given period, such as 3 years. Next point, using market data in valuation. Now, here again, we are looking at the perspective of the private equity firm, which is making investments in these portfolio companies and needs to value these companies. Often market data is not directly available for these companies because these are private companies. So what do? The private equity firm still wants to use market data in some form. So even though market data cannot be applied directly, but most valuation techniques try to use market data at least indirectly. And how does that happen? One is to use multiples for comparable companies. In other words, if this is a private company, but there are public companies that to some extent are like this private company, then obviously comparables will be used. And the comparable that is used, or the multiple that is used quite often, is the enterprise value to EBITDA multiple. Relevant transaction data. If there have been transactions in the past involving companies that are similar to these, then obviously that transaction data is used. Pure play method to evaluate beta. We have looked at this in corporate finance and equity, but obviously to evaluate these companies, at times you need to figure out what the appropriate discount rate is. To come up with a discount rate, if you are using CAPM, you need an estimate of beta. If these companies are not public, then how do you come up with the beta? What you use is the pure play method that you studied in corporate finance in level 1, and then we again saw this in equity in level 2. But there are ways of estimating betas given public market information. Not a perfect method, but it is a reasonable approximation as long as you find comparable publicly traded companies. In general, in private equity, and in fact, also with public equity, it is important to estimate the terminal value. You might have a forecast horizon of, let's say, 3 years, and at the end of 3 years, you need to estimate the value of your investment. That estimated value is the terminal value. How do we come up with terminal value? You have seen this over and over. Simplistically, either you can make a perpetual growth assumption and then use the Gordon growth formula, or you might use a multiples-based approach where you say that, look, at the end of 3 years, I expect EBITDA to be a certain number, and I expect that in this industry, the multiple is going to be, let's say, 6. And you can then use an estimate of EBITDA and an estimate of the multiple to come up with the estimated value at the end of year 3. All right, section 2.3, contrasting valuation in the venture capital and buyout settings. The curriculum gives a detailed table showing the differences between buyout investments and venture capital investments. What I'll do before showing you that exhibit is at least help you understand the 3 or 4 most important items. And to understand those important items, look at the bigger picture first. As I alluded to earlier, with buyout investments, the private equity firm is investing in relatively large, relatively stable companies which are not very efficient and essentially turning them around. With venture capital investments, the private equity fund is investing in small startups. So once you keep this in mind, everything else will just flow. If you think about the predictability of cash flows, where will the predictability be higher, with buyout firms or VC firms? Obviously, the predictability will be relatively high with buyout firms and relatively low with VC firms. With VC firms, in fact, most will probably not succeed, and those that will succeed will give you a huge return. What about the asset base? Generally, with buyout firms, the asset base will be substantial, whereas with VC investments, the asset base will be relatively low. The use of leverage. With buyout firms, in fact, when we talk about buyouts, we often say leveraged buyouts because typically a lot of leverage is involved over here. The cash flow is predictable, and what private equity firms do is they borrow money, use the borrowed money and some of their own money to make the investment, and then use the cash flow, which is relatively predictable, in order to pay off the loans. With VC investments, there is hardly any use of leverage. And then risk. Obviously, there are risks involved with both buyout and VC investments, but with buyout investments, the risk is much more measurable because you have a much better sense for the cash flow. Also, relative to VC investments, we can say that the risk is relatively low. So I'd say that these are the 4 critical points. Now, if you look at the list in the curriculum, it is shown right here. So it's a long list, and I would encourage you to read this, but keep in mind the main points that I just talked about. So you will see the list over here as well as on the next slide. So it's a laundry list. Read it a couple of times, but make sure you understand the main points that I just talked about. All right, section 2.4, valuation issues in buyout transactions. So as the heading suggests, our focus here is on buyout transactions. I'll give you a simple scenario here. Imagine you are the private equity firm. So you are the general partner. You spend a certain money and you invest in a company that is not very efficient. You borrow money at a relatively low rate, you put in your own money, and let's say that you make an investment of 100 million. And you have, let's say, a 5-year horizon. So if this is time 0, then after 5 years, you plan to exit. So obviously, when you exit, you want to exit at a higher value. So if you initially invested 100, let's say your goal is that over 5 years you get back 200. So where is this 100% return coming from? These are the major sources. One is earnings growth. If you do a good job of running the company, remember with the buyout transaction, what is happening is you are taking over an established company, one that probably is not being run very efficiently. So you align your interests as the private equity firm with the interests of the management. Maybe you provide some management guidance, you have your people on the board, maybe you even have your people helping run the company. So the company grows, earnings grow. Will that be a source of value? Yes. So that's one source. Another is multiple expansion. What this means is for an inefficient company, the multiple such as the PE ratio will be relatively low before your intervention. So it is conceivable that before your intervention, the PE ratio for this particular target company or the portfolio company now is 10. With your intervention, where the company now has become more efficient, maybe the expected growth rate is higher, what will happen to the PE ratio? It will go up. Let's say the PE ratio goes up from 10 to 13. Okay, does that add value? Yes, this also adds value. And then another critical element is debt reduction. What this means is, let's say that your equity investment was 100 million, but you also borrowed 300 million. Over the 5-year period, as this company generated cash, and remember with a leveraged buyout, you are investing in companies that are somewhat established, so there is a cash flow. One of the major uses of that cash flow will be to pay off this debt. So if the total value of the company initially was 400 million, 100 coming from equity, 300 from debt, and over the 5-year period, the debt is mostly retired. So if the value of debt comes from 300 down to, let's say, 150 million, then obviously your equity stake will be relatively high. So a third mechanism for generating value is by paying off the debt. This concept now will be explained, and this is not one of the boxed examples in the curriculum, but this has been taken from the main text of the curriculum. I will explain what this is all about. In the curriculum, there are several pages on this, but I'll just emphasize the important points. Again, imagine that you are the private equity firm and you are making an investment of 5 billion euro. We are working in millions over here, so we will say that the investment is not 5 billion. The entity that you are buying has a value of 5 billion. So that is written as 5,000 million. We will simply work like this. We'll call this an investment of 5,000, or we'll call this a total enterprise value of 5,000. This rectangle over here represents an enterprise value of 5,000. So how do you come up with 5,000? We are going to use debt. So let's say that 50% of that 5,000 is borrowed money, which is 2,500. So this is the amount of debt. Then of the remaining 2,500, which is equity, we are going to say that preference shares, which are held by the private equity firm, is 2,400. So the preference shares, 2,400. This is the value of the preference shares held by the private equity firm. What is left is 100. So with the 100, we are saying that the common equity for the private equity firm is 95, and the management team of the company gets common equity of 5 million. Right? So that explains the entire enterprise value of 5,000. Another point here is to recognize that the preference shares will obviously have a dividend, and that dividend is a 12% rolled up dividend to preference shares. What does that mean? This means that the dividend will not be paid over the life of the investment. If this investment has a 5-year life, so it will be sold off in 2013. The investment was made in 2008, so this is a 5-year period. When we say 12% rolled up dividend, what that means is that this preference shares investment of 2,400 will grow at 12%, and then that entire amount will be paid at the end. So if 2,400 grows at 12%, what do we have at the end of 5 years? It will be 2,400 into 1.12 to the power of 5. And if you do the math, what you should get is 4230. This means that at the end of 5 years, the preference shareholders who invested 2,400 should have 4230 at the end of 5 years. So we move forward 5 years now, and let's say that the enterprise value at the end of 5 years is 8,000. If the enterprise value is 8,000, let us look at the various components. If you recall, one way that private equity firms create value is by paying off the debt. We don't need to go into the details, but the case tells us that the value of debt comes down from 2,500 to 1,600 because over the years cash is generated, and that cash is being reduced among other things to pay off the debt. So if the total enterprise value at the end of year 5 is 8,000 and debt is down to 1,600, the claim that the preference shareholders have is equal to 4230, then how much do we have left for common equity? Remember, common equity is the residual. So you will have 8,000 minus these two numbers. So how much is that? It is 2170. Of 2170, 5% goes to management, so that is 109, and 95% belongs to the private equity fund, so that is 2061. Now what we can do is actually look at the return for the various investors. So if you look at the management team, the amount invested was 5 million. 5 million became 109 million, which represents an IRR of 85%. So clearly the management team did extremely well. They had their entire return in the form of common shares, and the value of those common shares went from 5 to 109. The private equity fund invested 2495, so that's the 2400 preference shares and 95 common equity, so the total amount was 2495, and their total return was 20%, IRR of 20%. So why is it that the management has a much higher return relative to the private equity fund? It is fairly clear. The management had their entire money put in common stock, so high risk, high return, whereas the private equity fund took less risk. Most of the private equity fund money went into preference shares. So the private equity fund not guaranteed, but essentially lowered their risk by having preference shares, which meant that they would at least get their 12% before any other payments are made. When you combine the preference shares with the common stock, effectively the IRR became 20%. Section 2.5 deals with valuation issues in venture capital transactions. This is very straightforward, and you will just learn one of the simplest formulas in the curriculum. PRE stands for the agreed value of a company prior to a round of financing or investment. The investment amount is denoted by I. So if you have a small firm, it hasn't yet received any outside funding, it will still have some value. That value is called PRE or pre. And then post is a value of a company after the financing or investing round. So what is the relationship between post and pre? Post is simply equal to pre, which is the value before an investment plus the value of an investment. The reason we need to understand this is if you have a small company, which is, let's say, owned by the founders, and then some outside private equity firm makes an investment, do the founders and the outside investor need to agree who owns what fraction of the company? Obviously, they need to agree who owns what fraction. So the proportionate ownership of the venture capital investor is equal to I over post. Fairly straightforward. So the proportionate ownership of the outside investor, the private equity firm, is given by this fraction. Now, just to illustrate the point, a VC firm invested 1 million on a 1.5 million pre-money valuation, and the VC firm obtains 40% of the shares. In this case, pre is 1.5 million, post is 2.5, which is simply 1.5 million plus the investment, and the proportion financed by venture capital is 1 million over 2.5 million. The parties agreed that the VC firm would retain 40% of the shares and have that proportion of the rights of shareholders should dividends be paid or if the firm is sold. Now, this looks extremely simple. The case study in the appendix is built on the relationship that we are talking about here and the fractional ownership. So that will be a separate lecture. Section 2.6 deals with exit routes. In other words, how do investors get their cash back? Again, the perspective is that of a private equity firm. The private equity firm makes investments in portfolio companies. How does the private equity firm exit those investments and get money? There are several methods. The most attractive one, and one where the returns are likely to be the highest, is an IPO, an initial public offering. So this will give the highest exit value relative to other methods. High liquidity, access to capital, and attracts good management. So if a company goes IPO, then obviously the shares become more liquid. If a company is likely to go IPO, then that will attract good management. Less flexible, more costly and complex. While an IPO gives the highest return, but generally it is quite expensive to go IPO. The listing requirements tend to be quite high, and also a company needs to meet certain criteria in order to be listed. This method is used when the company has strong growth prospects, a decent operating history, and a reasonable size. The point being that the purpose of an IPO is to be able to raise funds and raise funds more easily. So it only makes sense to do this if the company actually needs funds and the company has a very bright future where those funds will then allow the company to grow fast. Keep in mind that the timing of the IPO is an important consideration because, like everything in finance, the IPOs are also cyclic. There are times when IPOs are hot, in which case even average companies can get funding quite easily. And then there are times when the IPO market is almost dead. So companies actually try to time their IPOs based on the market situation. Another exit strategy is what's called secondary market, sale to another financial investor or some strategic investor. If you recall, when I was talking about VC companies earlier, I said that different VC companies can specialize in different stages. So there might be some VC company that takes on very small startups which are early in their life cycle, take them to a slightly later stage. Maybe the product is developed and the product is now being marketed, and at that point a sale is made to another VC firm that specializes in that stage. So this would be a sale to another financial investor. Or what happens quite often is a sale to a strategic investor. Many years ago, when I worked for Oracle, Oracle would actually buy several small startup companies. So that would be an example of a strategic investor, where a small company has gotten to a certain level with their software and Oracle wanted to get into that market. So rather than organically developing that software, Oracle would buy a company, a small company that had already developed the software to a certain level. So that often also results in a decent payoff for the investors and the founders. A third scenario is a management buyout, where the firm is sold to the management. So you might have a group of people who started a company, hired the management, and then the management figures out a way of putting their own money and borrowing money, and using their pool of money, they pay off the original owners, and then the managers become the owners of the company. So that's called a management buyout. And the final scenario is liquidation, where if a given company has not done too well, or the investment has not done too well, and the outlook is bleak, then the best scenario is to simply liquidate the assets, pay off the liabilities, and then if anything is left, that is distributed to the original investors. All right, a quick summary of section 2 now. Because of the difficulties in valuing private companies, a variety of alternative valuation methods are typically used to provide guidance on the appropriate range of prices. So this is a no-brainer. You don't just use one method, you try to use as many methods as possible. Also recognize that valuation serves a dual purpose. Number one, assessing a company's ability to generate superior cash flows from a distinctive competitive advantage. And the second point is that valuation helps serve as a benchmark for negotiation with sellers.